Welcome to episode 3 of LuxVoyagEchoes. I'm your host Madhvvi, and today we are tackling a topic that always on the minds of investors: market volatility. Navigating the ups and downs of the market can be nerve wracking, but it's essential to managing investments wisely. Joining us again is Mr. Akhil Chaturvedi, Executive Director at Motilal Oswal AMC. Akhil, it's great to have you back to discuss the critical topic. Market volatility can be overwhelming for investors, especially when they are focused on long term goals, yet have to navigate the short term fluctuations. So, my first question is: how do you advise investors to balance their long term financial goals while managing short term volatility?
This question largely applies to equities. Equities is all about long term, right? So there is no shortcut. Like I said, in my own case, I've burnt my fingers in the initial investing when I tried to make a lot of money in short term. So equities is all about long term. In long term, while you go through a lot of ups and downs in the market, you stay the course. Eventually, the power of compounding will play out. What we have seen in our markets is that over the last 40 years, if you just take the Sensex, started off in 1979 with 100 points. Today it is 85,000 odd, so 850 times up. But this has happened all over 40 years, and after going through all kinds of volatility, corrections, all kinds of economic chaos, geopolitical issues, COVID, Lehman crisis, everything has happened over. But in the last 40 years, index itself has compounded at about 14%. Given where we are as a country, we are all talking about India at 100, the Amrit Kal 2047, India will turn 100. Don't be scared of corrections, don't be scared of volatility. Just stick to your asset allocation. If you've decided X percentage to equities, stick to that percentage. If your value goes down, add more to equities. If the value goes up, you can take your profits off and rebalance your portfolio. Continue doing this for 10, 20, 30, 40 years. Sky is the limit in terms of wealth creation. Eventually, equities is the only asset class, probably after real estate, which can really help you create a lot of wealth over long term.
That's such a valuable advice. It's reassuring to hear that investors should not let short term volatility detail their long term plans. I especially appreciate your emphasis on sticking to a well thought out strategy rather than reacting emotionally to market swings. It's a reminder that even though the market may fluctuate, the key is to keep the bigger picture in mind and stay committed to your financial goals. So, my second question would be: should they adjust their strategies during periods of uncertainty or stay the course?
During extreme uncertainties, let's say recently we went through COVID about 4 years back. I mean, in those times, you shouldn't do anything. You just have to keep quiet, right? What generally people tend to do is sell out at that point of time. That is what one must kind of avoid, right? So when we talk about long term, what is long term? Long term is that you have to live through a lot of short terms, and within the many short terms you live, there would be periods where markets will drop 30-40%. That is the time when patience is tested, and those are the times when you have to strictly stay on course. Like I said, if the value of your equity will drop by 30-40%, you need to rebalance your asset allocation, add more to the equity portfolio. In essence, what you are doing is when the prices are down, you're adding more, so you're buying low, and the more you buy low and then you hold on for a period of time, the compounding effect will only be higher. So in times of uncertainties, be patient, believe in the funds you are owning, the fund managers you're owning, or if you're owning direct stocks, then the businesses itself. Short term is doesn't last too long, but long terms really last for a long while, right? So keep that in mind and stick to your asset allocation.
It's really insightful how you advocate for a balanced approach, knowing when to review your portfolio and make small tweaks, but not letting fear dictate your decisions. Your advice to focus on the fundamentals and keep a disciplined approach, even during uncertainty, is something that I'm sure our listeners will appreciate. It takes the pressure off feeling like they need to constantly adjust their strategy with every market headline. That wraps up episode 3 of LuxVoyagEchoes. A huge thank you to Mr. Akhil Chaturvedi for shedding light on how to navigate market volatility while staying focused on long-term financial goals. I hope today's discussion gives our listeners the tools they need to weather market storms with confidence. In our next episode, we will be diving into episode 4, Technology and Innovation Transforming the Future of Asset Management. So don't forget to tune in our more valuable insights. Until then, I'm your host Madhvvi, and you have been listening to Lux Voyage Echoes. See you next time.